Good afternoon, friends. I'm Sandeep Biyani, heading business development and sales at Alpha Credit Advisors. It's my pleasure to welcome you all to AAA Investor Connect. Joining me today are some of the key leaders of Alpha Credit Advisors: Mr. Rajesh Kothari, founder and managing director of AAA; Mr. Govind Agrawal, director and investments; Mr. Yuraj Nemade, head of our western region; Mr. Rovin Chaudhary, head of our north region. Welcome, everyone, and thank you for joining us. Today, we are looking at why India is entering a true inflection point and why 2026 could surprise all of us. Several powerful shifts are converging: a maturing investment and capex cycle, potential second stage reform, rising domestic liquidity, and a broadening corporate earnings base. At the same time, global supply chain reorientation is positioning India more strategically than ever. Over the next few minutes or like 30 to 45 minutes, Mr. Kothari will explore how these forces could reshape India's growth path, influence policy priorities, and potentially redefine market expectations. Let's dive into what makes this moment so pivotal and why the 2026 could be far more interesting than most people anticipate. Welcome, Rajesh.
Thank you, Sandeep. Thank you very much.
Rajesh, I think there are many new investors joining us today and many may hearing us for the first time. So I again request you just dive into some before starting the topic, just requesting to give some brief introduction about our core investment philosophy and style. Over to you, Rajesh. Thanks.
Thank you, Sandeep. Good evening, everyone. First of all, I would like to thank each and every our investor as well as all our partners for supporting us wholeheartedly for last almost like 16 years. Our flagship plan, AAA IOP, AAA India Opportunity PMS plan, has completed 16 years last Friday. And in last 16 years, we have delivered consistent performance, not only delivering alpha compared to the benchmark indices, but also importantly managing risk well by having beta less than 1, less than BSE 500. This journey from last 16 years would not have been possible without support of each of our partners and the investors. So thank you once again for giving us your support. And also thankful to everyone for giving your valuable time on this evening. Last 13 months, market is volatile and there are a number of things happened in the market. But before I dive into market in the benefit of the new participants, let me quickly talk about maybe just 2, 3, 4, 5 minutes about our investment philosophy and about our investment process. Friends at our Alpha Accurate Advisors, our philosophy is protect capital, create wealth. The risk management is central pillar of our entire portfolio construction. We strongly believe that India being the one of the fastest growing economy in the world, equity as an asset class will always deliver long-term wealth for any equity participant. But same equity journey is not going to be linear, and there are going to be drawdowns during that journey. And hence, the job of a fund manager is how to manage that drawdown by falling less in the turbulent environment wherever the market goes reverse. And at the same time, how to generate wealth in the long term. And therefore, the risk management is the first important priority at Alpha Accurate Advisors. In terms of our investment style, it is a very unique investment style which is called cogility. It is a combination of quality plus agility. Be selective, be quality conscious in what we buy, and at the same time, be agile enough to get out of it. I'm sure all of you would agree with me that the world is changing fast. The business cycles are getting shorter, and therefore, it is very important to make sure that our portfolios are aligned for how the world is positioned for, how the sector is positioned for over next 12, 18, 24, 36 months. We would not like to predict next 10 years because I don't think anybody in this room knows how the next 10 years will look like. But surely we need to predict how we are looking at the business cycles over next 12 to 36 months. At Alpha Accurate Advisors, we therefore believe in not only buying the best, but monitor that business cycle of what we bought and then get out of it at right time. There are many companies. There were blue chip companies 10 years back, 20 years back, 30 years back, but today nobody even knows stock price of many of such companies. And that again proves the point that just buying right is not enough. We also need to make sure that we exit at the right time to ensure that the wealth is generated not only on paper but actually in our bank accounts. That's AAA investment style, which is a causality with the right stock selection and disciplined exit strategy. In terms of stock selection, we buy the market leaders with best of the governance, best of the financials, best of the management, and best of the growth. The growth is critical. At times, there are many investors, they do stock transfer to our portfolios. And many of their stocks are actually very big companies, large companies, beautiful companies. But the great companies doesn't necessarily mean the great growth. For example, one of the largest two-wheeler company in India has reported only 5% earnings growth for last 10 years. Or one of the largest FMCG company in India, for example, Unilever India, has reported very low single-digit profit growth for last 10 years. Or one of the largest multinational, again in Indian FMCG sector, called Nestle, has reported flattish growth for last almost 10 years. So the companies might be great, but that doesn't necessarily mean that it will continue to deliver high growth. And when the company fails to deliver high growth, the returns are also disappointing, subpar, suboptimal. And hence, we buy the company which are not only best in governance and management, but they must have the underlying earnings growth faster than the GDP growth of our country. Once we buy at a reasonable valuation, and post we purchase, we monitor business cycles. If the stock goes up too fast, too soon, we get our target price of next 3 years in a matter of 9 months or 12 months or 18 months, we do exit from such companies. If we believe that the earnings growth is not going to come through from high growth, it is entering into a slow land growth due to whatever reasons, maybe macro reasons, maybe micro reasons, maybe tariff reasons, maybe geopolitical conditions, then we need to exit. And last but not least, we exit when we think that our thesis is not going right and there are punctures in our investment thesis. That is called internally 3R process: review, repair, and regenerate. That's a constant 3R process at AAA, and that's what results into delivering this consistent performance. Friends, Alpha Accurate Advisors is a very boutique investment management firm. This firm is having the best of the team with the best of the culture, the professionals. At the same time, each of one, we have a common, what I would say, common thread, and that is the hunger and passion for equity markets. And that's what the passion that drives us to not only keep working on daily basis, but more importantly, enjoying what we are doing 24/7. With that, let me quickly take you through our investment outlook from here on. Please give me one moment while I share my screen. So if you look at last 13 months, market has been actually seeing the number of, I would say, events which have happened in last, 15 months or so. And if you look at last 1 year, markets are almost like, of course, as on today basis, up about 6-7%. But I think 20 days back, it was like showing a 0%. And last time in the webinar, I was mentioning that at times, 0 is not a bad number. Because in last 13 months, we have seen the geopolitical wars, we have seen the tariff wars, and during such times, market could have been easily down 20-30%. But thanks to I think, the global political leadership, the bureaucrats, their maturity, the world GDP growth has not impacted. India GDP growth also remained by and large resilient, and therefore market didn't went down, but it actually remained flat. From here on, I believe that India is at inflection point. When you look at over next 12, 18, 24 months, there are many skepticals in the market, and I keep seeing the frontline channels as well as the newspaper headlines, and there are a lot of concerns and that what will happen to the growth, whether growth will revive, whether the valuations are already very high, whether the AI bubble will burst in US, will that lead to again crash into Indian equity market, and so many narratives are going on in the market. So I thought, let me give you our views and our perspective. Then how do we look at India from here on? Friends, if I look at the macros first, the biggest enemy of equity as an asset class is the inflation. And if you look at the India, the inflation, as you can look at in this chart, has been constantly trending down. In fact, the headline inflation is less than 0.5%, while the core inflation is about 4%. Both CPI and CFFI are constantly declining. The cooling inflation set the right amount of, I would say, enough room to RBI to take the required monetary support. So this is the first important thing, that the inflation is cooling down. If you look at our RBI 10-year interest rates, RBI took a very, very bold steps by cutting rate by 100 bips. That is a bold step by RBI. And I'll come back to this point. This is very, very important point, that the RBI has become a pro-growth. It is a commodity policy announced by RBI. 100 bips rate cut is not small. It is not a symbolic rate cut. It is a very, very bold step by RBI. So one, inflation is cooling down, and second, interest rates are reducing. When you look at the crude oil, one of the most important, I would say, the commodity for India, the crude oil is also has been reasonably stable, I would say, despite a lot of geopolitical conditions. The crude oil has not went up through the roof. It remained, at around its 20 years average, which is again good news for Indian economy. And this is something very important, the RBI, the liquidity data. Friends, till month of, I would say, February, the Indian economy was choked. There was a liquidity deficit in the system. There was a credit choke, whether it is a corporate credit, whether it is a retail credit, whether it is a secured lending, whether it is an unsecured lending. There was a lot of tightening measures adopted by RBI during 2023 and 2024. But post new governor came in, inflation was supportive. He took a bold step, reduced the rate by 100 pips, and they didn't stop over there. They infused almost 11 lakh crores in the system. This is critical because the entire liquidity which was choked, and that resulted into the spillover effect on the entire economy, RBI addressed that by in fact injecting almost 11 lakh crores in the system. And as you can see in this chart, from April 25 till date, the liquidity surplus continues by RBI. In fact, I was speaking with one of the big banker of this country, and you'll be surprised that despite there is a rate reduction announced by State Bank of India, the CASA, SA part of it, there is a current account and saving account deposits have moved up. It didn't impact despite SBI cutting the deposit rate on the savings account. Despite that, SBI witnessed reasonably good deposit growth. So this is very important. So on one hand, the RBI injected liquidity. On the other hand, RBI reduced the interest rates. If you look at last 4 years, the capex, if you look at the center capex as well as the state capex, center decided to took the leadership to revive the Indian economy. And as you can see here, from 4.3 post-COVID, this is a COVID period where center spent roughly 3.4 trillion. And from 3.4, they consistently kept increasing the number to almost 10.2 last year and budgeted for 11.2 in FY26. Significant jump. Look at the number from 3.4 to almost 11, roughly 2.5 times in a matter of 5.5, 6 years. And if you look at the state government as well, they also increased their capex from FY20 4.2 levels, increasing to 5.3 and further increasing to 10.5, almost doubling in last 4 or 5 years. This is again very, very important because central government decided that they will push the capex first, and the capex will lead to ultimately growth in the underlying multiplier effect, and the multiplier effect will lead to improvement in consumption. But what happened was a little bit different. While the central government kept doing the capex on their part, the consumption was lagging. The more tax compliance, the more GST numbers, and so on and so forth. And at the same time, the lower strata, the lower demographic side of Indian economy, they got actually really hit by COVID and demand slowdown. And that resulted into the consumption not moving. And this consumption further got chopped because RBI also, as I said in 2023 and 24, little bit did the tightening. So while the capex was on stream, the consumption got impacted. And this is second very important point which I wanted to highlight you. And because of that, the capacity utilization was still hovering around 74, 75. 75% is a very good number. But if you want to really go to the next level of growth, this 75% you have to not only maintain, but you have to make it 77, 78, 79%. And if that happens, that's when the private sector capex comes home. And if the public capex and private capex both are on fire, then that leads to the much stronger GDP growth compared to 6.5%, which India is growing currently. And then what came was a gift, one from finance minister during the budget, and second was by the government of India by announcing the GST cut. And if you look at here, the total effect of GST as well as income tax rationalization is roughly almost 2.8 trillion. Rupees 2,800 billion means translated to roughly 2.8 trillion. And in fact, if you add the benefit of interest rate cut, it adds another roughly 1.5 trillion. So roughly 4 trillion was basically given to the consumption class, to the Indian middle class by savings through income tax, by savings through interest rate, and at the same time by reducing the GST, making their purchasing power higher by almost 4 trillion. And that is actually the game changer which got announced in month of September. And this basically will lead to final improvement in consumption, which was a punctured, and that consumption along with capex will lead to the better credit growth, and that better credit growth will lead to better capacity utilization, and that better capacity utilization will finally result into the much stronger and better earnings growth. When this GST cut announced and also the rate cut announced along with the liquidity, the first green shoots are already visible. If you look at the credit growth has been now almost touched close to 11% in the recent months. This is very, very important. It's the first time in last 12, 13, 14 months, we are back to 11%. Remember, our peak was 12. From 12, it moved down to as low as 9%. In fact, even sometimes even lower than that. So 400 bips reduction in credit growth was a shocker to economy. And that's why economy was not moving, despite government is doing its best by supporting through capex. And once government did the GST cut, at the same time infusion of liquidity by RBI, now the credit growth has started improving. Of course, it is early days, but I believe that credit growth will continue to remain in good double digit. 11, 12, 13% is credit growth what we are factoring, and that is a very healthy credit growth to achieve the better GDP growth and better earnings growth. The first effects is visible not only in credit growth, but even if you look at the automobile sector numbers, it is a record high on festive surge plus GST cut. And as you can see, the total vehicle registrations went to almost like all-time high. It has crossed roughly 42 million, for 42 lakhs. And that's all-time high, whether it is a car sales, whether it is a SUV sales, whether it is a two-wheeler sales. Even the tractors did very well because rural India has also bounced back quite healthily in last 3, 4, 5 months, thanks to good rainfall. So the early indicators are already visible through auto sales, through festive sales, and also through credit growth. Even in the commentary of the second quarter results, many of the consumer companies with which we discuss, like for example, jewelry sales, not only in month of Diwali, but even in the month of October, if I speak with the top 5 listed companies into jewelry segment, they have kept saying that the growth in October has been also very, very healthy. If I speak with the largest auto dealers in this country, their feedback is very positive. The festive season is over, but yet even in month of November, as on today basis, they are seeing a reasonably good traction. There is a fear that it is a one-time kind of a demand because of GST cut, because everybody postponed their decision to buy auto in the month of September post GST. But not only the September numbers were good, not only October numbers are good, but even November looks reasonably good numbers across, whether it is a PV or whether it is a SUVs or even to certain extent even for two-wheelers. The inventory in the system is also very lean. It is no more what I would say pushed inventory into the system. The inventories are at reasonable levels. In fact, for Maruti kind of companies, the inventory is actually a little bit lesser than what they used to keep over last 12, 18 months. So GST cut is finally leading to the better consumption numbers, and that's what early indicators we believe are suggesting. When you will see the consumption growth, and then when you will see the continuity of capex, that results into the better credit growth. And it is that trinity of consumption plus capex plus credit growth is equivalent to better and stronger Nifty EPS growth. If you look at FY26, our EPS growth is only 8%. So many of investors, they ask that why last 1 year market is up only 6-7%. Market is up only 6-7% because Nifty has delivered only 8% EPS growth. And market in long term is nothing but the mirror of earnings growth. But as I said, as we move into FY27, which is nothing but the starting month of April, we are already in month of November. The first quarter results have been already over. Second quarter earnings season is already over. So second half itself is going to be better compared to the first half. And as we move into FY27, we believe that the earnings growth will bounce back to strong double-digit 15% plus earnings growth. And therefore, we are bullish on the market because of the supportive macro, low inflation, low interest rates, at the same time, better and stronger corporate earnings growth driven by stable capex, improvement in consumption, and improvement in credit growth. All these factors basically makes picture perfect. If the Nifty EPS growth remains double-digit healthy growth, generally, as I said, market is mirror of earnings growth. How we stand in terms of, people keep asking what is the view on mid and small cap versus the large cap. And if I look at mid and small cap, their earnings growth is much, much stronger compared to large cap. In fact, for second quarter FY26, the BSE 150 reported 33% earnings growth. BSE small cap reported 16% earnings growth. This compared with BSE 100, which reported very, very subpar, only 3.6% earnings growth. So there are many naysayers in the market, and they give warnings that don't buy mid and small. But our view is different. Our view is, first of all, define. How would you like to define mid and small? For us, it is like top 1,000 companies are basically the good companies, and anything beyond 1,000 is really where the problem is a little bit much severe, and one should avoid beyond 1,000. So out of 5,000 listed companies in India, we are positive on top 1,000 companies, and beyond 1,000, which we call in our terms micro cap, is the space which we should avoid. But mid and small cap within 1,000 is a space to be in, to be remain invested in that space, and that's a space which is going to create alpha because the growth is much faster. Please remember, there is coming with a very strong balance sheet. It is no more 2012 that the mid company or small company debt equity is 3:1. No, sir. Most of them have repaid their debt. Most of them are cash rich companies. They have a good ROE, they have a good cash flow, they have a good leadership, they have good governance. Many of these companies are market leaders, and therefore top 1,000 companies are good, remains our good universe to remain invested, and that's where the growth is going to come. As I said, when people talk about mid cap, I would like to clarify that while the top 150 companies, if you look at their company's profit size, almost 87% of these companies, they were 500 crores plus reported net profit after tax. Many of them are real market leaders. They've developed their niche. Many of them become globally competitive. Many of them are across various sectors like auto ancillaries, like, for example, very strong capital goods companies. There are many companies which are into CDMO space. There are many companies which are into the hospitals and healthcare. There are many companies which are in the new age business like platforms. And there are many companies which are into, of course, fast growing housing finance companies. This is a space. They are no more small companies. They are actually not mid-sized companies. They are 500 crores plus profit making, and therefore they are actually very big companies. But because of the regulatory definition, only top 100 by market cap is called large cap, and the next 150 is called mid cap. But in my view, these are not mid-sized companies. They have already arrived in their life. And as I said, their growth has been very, very strong and resilient, 30% growth even in second quarter. What about small cap? Well, as I said, we did a very lengthy exercise, and we analyzed roughly 1,400 companies. And if you look at these 1,400 companies, almost 50% of these 1,400 companies, roughly 700 companies, they are actually making reasonably decent profit size. 38% is making 100 crores plus profit, and 15% is making 50 crores plus profit. So you can imagine if they keep growing 18, 20, 25%, 51 become 100 crores in a matter of 2.5, 3, 4 years. And similarly, if a company which is making 100, 200, 300 crores kind of a profit, if they grow 20, 25%, they soon will become 500 crores club. So within small cap, as I said, we prefer to be into the side where the profit size are at least 50 to 100 crores plus, and avoid the companies where the profit size is below 51 crores. So 50% of small cap of this 1,400, we like it, and 50% of this other half is basically the micro cap, which one should avoid. Where are we in terms of valuations? And often I get questioned that markets are overvalued. And I don't think so. There is a lot of time correction. There is a good amount of price correction. And if you look at market on a FY26 basis, we are roughly trading at 22 times, which is equivalent to our 10 years average price to earning multiple. But the moment you look for FY27, which is not too far, because generally market looks at 12 to 18 to 24 months forward. So on a 16 months forward or 17 months forward, we are trading at roughly 19 times, which is a reasonably good, I would say, discount of 11 to 14% compared to 10 years average. Now, what will make 19p to 22, 25p? For that, what you need is a better macroeconomic environment and the reasonably good micro environment. Our macro environment is very good because, as I said, inflation and interest rate both are cooling down, and the micro environment is improving because the earnings growth is going to bounce back. And as that happens, we believe there is a strong possibility of Nifty going back from its 19 times price to earning multiple to at least 22 times price to earning multiple. Please remember, there are many events, there are many times in last 15 years, market went higher than its 10 years average. And for that to happen, what you need is exactly what I talked about, the faster, the better super earnings growth. So if the Nifty earnings will keep doing at around 15, 17%, then there is a good possibility that P expansion can also happen and we can cross 22 times price to earning multiple as well. So it is a reasonably good margin of safety in my view. And therefore, I believe that the next 12 to 18 months looks very bullish to us. India is an inflection point, and this is a very good time to allocate money to equity as an asset class. I believe that 2026 and probably even in the medium to long term, equity as an asset class will continue to outperform most other asset classes, be it real estate, be it a fixed income, or of course being a gold. We don't know about Bitcoin, we don't have expertise on it, but otherwise most other asset classes, equity should continue to outperform. Of course, markets are going to remain volatile. So volatility is name of the game. You need to adjust and absorb the volatility, keep a little bit longer term time horizon, and make sure that you have a wealth creation objective with a 4 to 5 to 7 years time horizon. So this is about the equity markets and our view on how we look at Indian equities. Let me briefly talk about how AAA IOB PMS and AAA Budding List PMS, how both are positioned for this market. Please give me one moment. So this is AAA IOP. This is a multi-cap portfolio, as you all are aware, and this is how the sectoral allocation looks like. We have increased our exposure to banking. Is right now the largest exposure. 31% of the portfolio is in banking. Within banking, we own corporate banks. We also added PSU banks. We also have a affordable housing, and we also have a commercial vehicle financing. During this presentation, we may talk about few companies' names. Those are not recommendations, and our PMS and our other investments, personally or even for the clients, we might have positions for the same. These are not recommendations. We may buy or we may sell once we discuss any of these names. So I'm just, whatever names we are talking about, it is basically just to explain what we do and what is our investment style. So within banking and finance, we continue to have Chola Finance, which is one of the core holding from almost like 4+ years. We also own Shriram Transport, which we identified right time about 2 years back, and stock has gone up significantly from 1,300 to almost 2,000 plus, and many more such companies within banking and finance. We believe that the banking and finance will do well because number one, the credit growth is likely to pick up. That's something very important. Better credit growth, better disbursement growth, it means the better interest income over longer term. Second, the banking and finance got impacted in terms of the net interest margins in last 6 months because there is a time gap between repricing between your loans versus your borrowings. But we believe that as we pass next 2 quarters, FY27, banking will report very strong growth, even on net interest income, because NI, which got impacted, will bounce back. And third important, of course, the asset quality. And throughout this entire NBFC sector and banks and finance sector, we have seen the improvement in asset quality trends. Even the worst sector, which was microfinance for last 4 years, finally is also seeing light at the end of tunnel. And then also we have seen the improvement in collection efficiency, and which hopefully means the better credit cost even for microfinance sector. But throughout the sector otherwise, be it a private sector banks, be it public sector banks, or be it a even NBFCs, most of them, they've reported very strong asset quality trends. Second sector is capital goods, which is engineering. And as you are aware that we are very, very selective when it comes to capital goods. Our exposure is primarily the new growth drivers, the companies which are likely to benefit significantly from HVDC transmission capex by Government of India over the next 3 to 4 years. Companies which can get benefit where the data center is going to become 5 times in next 5 years. Companies which can benefit by spend on the metro railways. The companies which can benefit because of domestic as well as export opportunity of the better industrialization. These are the kind of companies what we have in capital goods. We remain positive on of our top holding, which is Hitachi Energy, which has become multi-bagger for our portfolio since our purchase in last 2.5 to 3 years. The next is the pharma, which is 8.5% of the portfolio. Earlier, pharma was about 10% plus, which we reduced post GST cut because other sectors are going to get benefit, and therefore pharma we have a little bit reduced our exposure. Within pharma, what we own is a companies which are going to get benefit because of CDMO, and I think India has a huge opportunity on CDMO space. And also we own companies which will basically benefit due to healthcare spend, the hospitals. Fourth sector is automobile and auto ancillary. And this is a sector which has been a very strong performer for us throughout last 4 or 5 years. We continue to have our two-wheeler exposure in the form of TVS Motor. I think we almost bought about 3.5 4 years back, and stock has delivered extremely strong returns. It's the best performing two-wheeler company in this country, not only in terms of volume growth, also in terms of the market share, their premiumization policy, their EV policy, where also they became one of the largest player in EV, and of course, very strong earnings growth. We also have auto ancillary companies like Uno Minda, which went up almost, I think, 10,000% in last 10-11 years, 100 bagger in 10-11 years, consistently grew about 32 to 34% compounded in last 10-11 years. So we believe that ancillaries will always benefit a little bit more compared to OE, because the content per vehicle opportunity is much bigger for auto ancillary companies. Next is consumer, roughly 7.5% exposure. And here we own, generally, broadly, the discretionary side of consumer. We hold the proxy building and material companies, which are into wire and cable. Here also we reduce one of our large holding, some time back, which is a Trent, which of course delivered excellent returns to us. We bought in, I think, September 2020, and we started reducing our exposure from April 2025. Stock is almost down, I think, 35-40%. Fortunately, we reduced our exposure from 3% to 1% about 4 or 5 months back. We still like Trend, but I think the growth is one thing which we believe probably will take some time before Trend sees the improvement. Software is 7%. We remained a little bit underweight on software. But within software, our largest exposure is Coforge, which is the best performing mid-cap IT company in terms of organic revenue growth, profit growth, as well as, of course, in terms of the stock price performance. Specialty chemical is 6% of the portfolio. As you are aware, way back in 2019, we bought specialty chemical. We made, most of them were multi-baggers for us and created huge wealth for our investors. By March 2023, we made it zero. And then again, about 1 year back, we started taking exposure to specialty chemical. We identified Navin Fluorine, or rather we bought back Navin Fluorine, which we exited a few years back, 1 year back. And from there, again, the stock is almost up about 75 to 85%. So that's specialty chemical. We are very, very selective. We buy the businesses where there is a real moat within specialty chemical. Like, for example, Navin Fluorine, is one of the few companies where the Honeywell has given their patent. One of the few companies which is into supplying the specialty chemical which goes for data center cooling, liquid cooling agent. Very, very differentiated business. Very, very ROC conscious management, and high end within specialty chemical. Telecom is roughly 5% of the portfolio. Here we own Bharti Airtel and also the Indus Tower. Both have been doing reasonably well. And there is something called others. Here we own very interesting businesses. Like, for example, we continue to own MCX, Multi Commodity Exchange, the largest player within commodity exchange. And earlier the biggest dependence was on crude oil. which is now the bullion, gold and silver volumes have of course gone up through the roof. They have kept introducing the new products, expiries, and the lower ticket size, and so on and so forth. And that resulted into significant increase into bullion volumes compared to their historic dependence on crude oil. So a nice company, a focused company, and biggest beneficiary of increasing, I would say, futures related thing on commodities on the exchanges. So India is a huge opportunity compared to many other exchanges in the world. Our commodity turnover is still very, very low compared to many other companies in the world. So that's complete our triple IOP, how we are positioned for. And in terms of quantifying the quality, one of my favorite slide, and I keep talking about this slide. I'm sure that every manager says that my portfolio is a good portfolio, but internally we always believe that we should define how good is our good. So AAA IOP is a pure multi-cap. Rough average market cap is 4,20,000 crores, 50% large cap, 50% mid and small cap. Very important to note that while 50% is into mid and small cap, most of our portfolio companies, they are large by profit size. That's very, very important. Almost two-thirds of the portfolio have 500 crores plus reported net profit after tax. The large profit size gives you the resilience. It's very, very important because whenever the market comes down, your resilience will decide how much you lose money. Very important, the debt-free balance sheet or under-leveraged balance sheet. Most of the portfolio companies are under-leveraged. They have a very high ROE, which means good pricing power, and we buy only if there is a growth. So portfolio has a 26% earnings growth. Friends, AAA IOP is a multi-cap PMS, 50% large cap, 50% mid and small cap, 50 stocks portfolio, 50 stocks portfolio. Most of these companies are market leaders. Most of these companies are oligopolies. Most of these companies are monopolies. They are supported by best of the management, best of the governance, very, very conscious about financial risk. Most of them are debt-free or net cash companies. They are resilient because the profit size are very large. They have a pricing power, which gets reflected in ROE, and we buy only if there is a growth, because as I said, great companies doesn't necessarily mean great investment. For a great investment, the great company must have strong earnings growth. How our portfolio is delivered in second quarter? Friends, against BSE 500 revenue growth of 8% and profit growth of 14%, AAA IOP has delivered very strong revenue growth, 20%, and very strong earnings growth, 23%. In first quarter also, AAA IOP delivered 20% plus profit growth, and the journey of 20% plus continued even in second quarter by significantly outperforming the BSE 500 financials. This is one important slide. I know every investor loves to talk about returns, but as I said, I always believe first to measure the risk. And in last 16 years, as you can see in this chart, there are many times when market went down. But during most of those challenging times, our fall was lesser than BSE 500. During COVID time, our fall was lesser. During Russia-Ukraine war, our fall was lesser. And even during last year market correction, our fall was lesser. If I look at September to March period, when the average stock went down by 24%, our fall was restricted to only 18%. Protect capital. This is something very, very important. Time and again, we have demonstrated that protection of capital is something very, very crucial to deliver the long-term wealth. This is in terms of performance, 1 year, 2 year, 3 years, 5 years, and in inception, 18.2% compounding since last 16 years, 21% compounding in 5 years, 17% compounding in 3 years. I always believe that instead of looking at 1 month, 3 months, 6 months, 1 year, 2 year, 3 year, one should look at financial year-wise or calendar year-wise performance, whichever way you are comfortable. And if you look at here, in FY25, we delivered 13% compared to benchmark 6%. In FYTD 26, we delivered 10% compared to benchmark 11.8%. Slight underperformance, but look at that last year we had, of course, very strong performance, and this year in a tough volatile economic environment is always better to save the wicket first and then go for the runs. And we, of course, we are going for the runs, but at the same time we are being a little bit conservative during April to September period, where Donald Trump was changing the tariff policy almost on daily basis. In terms of the beta risk analytics, our portfolio is a lesser beta compared to BSE 500 and very strong Sharpe ratio and very strong rolling returns. Very quickly on AAA Budding Beast is a very unique portfolio, probably one of the special mid and small cap PMS which do not invest into mid and small companies by profit size. They invest into market leaders, they invest into best management, best governance, but many of them are tagged as a mid and small cap because they are not top 100 by large cap. In fact, our mid and small cap PMS Budding Beast offers strength of large with alpha and speed of mid and small. And that's very unique portfolio characteristics. If you look at AAA Budding Beast, just like our IOP portfolio, it is a very strong underlying characteristics. Our average weighted market cap is 37,000 crores. It is not below 10,000. So it means very, very big companies we invest into. Many of them are 100 crores plus profit. Most of them are under leverage or they are debt free. They have a very strong pricing power. And of course, undoubtedly, they have very strong earnings growth. Earnings growth is critical for long-term wealth creation. How this portfolio has delivered in second quarter? This portfolio has delivered extremely strong performance, 27% earnings growth in second quarter compared to 14% earnings growth by BSE 500. How has been the performance of Budding Beast? During bad times, it has significantly outperformed by falling less, protect capital first. That center for risk management of our entire portfolio construction remains valid even for AAA Budding Beast. How it is performed otherwise in the long term? 26.8% compounding. It has completed almost 4.5 years compared to benchmark 17.3, and even on 3 years basis, it has delivered 26% compounding. If you look at on financial year-wise performance during last year against 6% benchmark, Budding Beast delivered very healthy 16.4% good double-digit returns, and even in the current year YTD against 12% BSE 500, Budding Beast delivered very strong 17.6% returns. How is the beta of this portfolio? Very interesting. While it is called mid and small cap, its beta is even less than BSE 500 index, which speaks a lot in terms of for stock selection, in terms of the portfolio construction, and in terms of the risk management. How is the Budding Beast portfolio is looks like from the sectoral allocation? 14% is engineering, 13% is banking, pharma is 14%, which includes CDMO and hospitals. Chemicals roughly 9%. We continue to like auto ancillary, which is roughly 11%. Consumer is 13%. Software is 4%. Platform companies are 2%. And there are others which are 12%. Many of these companies we have been identified at the right time. Many of these companies have become multi-baggers in our Budding Beast in last 4.5 years. To share few names which really did extremely well in last 12 months, like for example, we have a TVS Motors, which almost went up 40% in last 1 year in automobile. We have a Uno Minda, again, which delivered handsome returns in last 12 months. In banking and finance, we have companies like Cholamandalam, which did extremely well in last 1 year. In capital goods, we have companies like Hitachi Energy, which went up through the roof in last 3 years since our purchase, and also I think up 80% in last 1 year. We have a Kim's Hospital in pharma, which is again doing a very strong, growing strongly, and will continue to expand their beds in next 2 to 3 years. In chemicals, we have a companies like Navin Fluorine. In others, we have a companies like MCX, which has done phenomenally well. We also own BAC in our portfolio in budding beast. Within consumer space, we own company, for example, the new entry the last 6 months has been a company called Aditya Infotech, CP Plus Camera, which is recently listed IPO. And since our purchase, stock is up almost 52%, and many more such names. The reason why I'm just sharing few names is just would like to again illustrate that while it is called budding beast, each of these company which I talked about, none of them are micro caps. Like TVS Motor is one of the largest two-wheeler player in this country, or Hitachi Energy has a 67% market share in HVDC technology. There are only three companies in the world which do business what Hitachi Energy does. They are into pioneer of HVDC technology. Or company like MCX, which is the largest commodity exchange, no more a small company. Or companies like even banking and finance like Cholamandalam is one of the largest CV financing player. Or companies like Navin Fluorine. There are only three companies in fluorine chemistry, and Navin Fluorine is one of the largest company within fluorine chemistry. So each of these companies, be it a Kims or be it a Hitachi or be it Uno Minda or be it a Gabriel or be it a Coforge or be it a consumer companies like Bikaji Foods, each of these companies are very solid businesses. They are run by very strong professional managements. They are the best of the governance, but they are not part of top 100 by market cap, and hence they are called mid and small. But by all terms, in terms of their resilience, in terms of their willing to fight for market share, in terms of their hunger to grow, in terms of their ability to take the financial leverage if required, in terms of their ability to do any inorganic acquisition if required, in terms of their ability to become a globally competitive business like companies like TVS and Navin Fluorine and Hitachi's of the world, they are probably the best positioned companies, not only in India, but they are very unique companies, even from the global lens perspective. And that's the speciality of budding beast. The companies are big, but their market cap is yet not into top 100. And if you do a study in the longer term, that which companies gets into top 100 and which companies gets out from top 100. Clearly, 2000 in 1999, in year 2000, the current top 100 companies were not part of top 100 that time. They were small caps, so-called small caps. Actually, they were big companies, but they were not into top 100 club. But slowly, gradually, as their profit kept compounding by 20-30% year after year after year, they made their mark and they made their entry into top 100. And many of them became the Nifty 50. AAA budding beast portfolio companies are rightly positioned in terms of the growth that at some point of time in future, if they continue to deliver well, they will move into that top 100 bucket over a period. In fact, three, four of our companies, when we bought in 2021, they were not part of top 100, but then they became part of top, like Trend. Trend was not top 100 by market cap when we bought it, but then it became top 100 by market cap. Of course, then we exited because we prefer to be into mid and small cap within budding based. So likewise, there are many companies which potentially they can become top 100 by market cap. So that's AAA, budding beast. I already talked about its performance and how also the portfolio is positioned. Last but not least, AAA AIF. This is a multi-cap, again, 50 stocks portfolio, category 3, open-ended. And just like IOP, the objective is to keep delivering stronger, resilient growth compared to the benchmark indices, and is doing reasonably well since its launch of last 3 years or so. So that's it from my side. From the products portfolio and positioning and performance perspective. And just to conclude, in terms of the from the market perspective, we are reasonably bullish on the market. We believe India is an inflection point, and this is a good time to invest into equity as an asset class. I think volatility is the name of the game. You can't skip the volatility. Take volatility to your advantage. Both of our portfolios, IOP and Budding Beast, we are rightly positioned to capitalize on any growth opportunity. In last 16 years, I have not seen many times when all external agencies, be it a finance minister, be it a central government, be it the bureaucrats, they all talk same language. I have not seen that. This is probably one of the rare time when we are seeing that. So with that, I would like to open up for Q&A. Thank you very much for hearing us patiently. Thank you.